Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for another Monday market update, 9 a.m. Eastern, every Monday morning. Get you ready for the week. Stocks I'm watching, economic news that could guide the week, and a big week ahead. We've got a lot of companies coming out with their earnings. We've got not only the Fed meeting that is expected to raise rates, but also the monthly jobs report that is expected to show that the economy is slowing down. Big week last week with some of those tech earnings. Just a few of the tech stocks, Microsoft, Amazon, Facebook, adding over $300 billion in market cap just to those stocks alone. So going to be a big week, but against this, we do have other economic news that could kind of break the mood. Friday's jobs report could show a weakening economy, as well as coming into a seasonal bias. In fact, one of the only market biases that actually has some weight and can move stocks lower. I'm talking about the sell in May phenomenon and the trend that there is a slowdown in stock returns during the summer months. We see here the monthly performance for Dow Jones Industrial from 1950 to 2012, a little bit older data, but 62 years of data does show that between the months of May through really September or October, those months are four of the worst months for stock market returns. Not only that, but October holds some of the worst market crashes in history. We're going to go further into the details of that strategy, that sell in May strategy, why it works, and how it can actually produce higher returns over the long term. Stick around though, because then after that, we're going to show our weekly market update, the stocks I'm watching, the economic news that could be very important for this week. I do want to get to that topic though, because here on the channel, I say always don't sell your stocks, hold your stocks for the long term. That best investing strategy has always been that long-term buy and hold style. But there are times that it makes sense to tactically hold a little more or a little less cash and make for those stronger returns. And one of those times is the sell in May strategy. And despite the fact that a lot of the investing rules you hear about are just weak at best or totally nonsensical, there is actual data to support this idea that selling or at least hedging your stocks in May through October period does produce a higher return. We're going to look at this data from 1950 to 2012, 62 years of data that proves this point, that stocks tend to fall during that May through October period and rise in the other 6 months of the year. Now understand, I'm not suggesting you dump all your stocks for the next 6 months. I'm going to highlight how I'm investing, but just looking at the extreme case for this, selling all your stocks. What would happen if you sold all your stocks during that May through October period? What your returns would be versus that buy and hold strategy is going to prove this phenomenon and that you have to take it seriously. So the sell in May strategy says you invest in the stock market, just the broad S&P 500 index from that November 1st through April 30th of each year. We see here in this chart, back on this chart, that those tend to be the best performing months of the year. For the other 6 months here, starting in May, where you see all this red here, in fact, the 4 only months throughout history that have had an average negative return, you go to all cash or a guaranteed cash-like investment like treasuries. But let's look at the actual data, the year-by-year data on this that proves this phenomenon. We can see the results of that strategy here in a comparison of stock returns over that 62-year period. The returns here from the S&P 500 from May through October, those from November through April, and then a simple buy and hold strategy. So we're looking at this in terms of 3 different periods, whether you just buy and held from 1950 all the way to 2012, whether you held stocks from May through October, or November through April. Each of these shows what would happen to a $10,000 portfolio. So the buy and hold, if you invested $10,000 from 1950 all the way to 2012, the November through April period, if you invested $10,000 from November to April of each year from November 1950 through 2012, and here the May through October period. If you started with $10,000, you invested only in the May through October period. The rest of the months you held cash, but if you invested only in stocks in that May through October period, how much would you have after the end of that 62 years? And we can scroll down here and see the results of that, and these are truly amazing what happens here. Investing $10,000 in that buy and hold strategy from 1950 would have produced a portfolio of $644,000. That's an annualized return of 8.1% over more than 6 decades, which is not bad and much better than just investing in that May through October period. We see here investing through May through October. So the results, the returns from that May to October period would have actually lost you money. If you had invested through that May through October period for that 62 years, you would have just $3,286 left in the portfolio. That is a loss over 62 years of investing. What is amazing though, and this is where that sell in May strategy comes from, is that if you had held stocks only from November through April of each year, again, remember this strategy says at its most extreme form that you sell all of your stocks, go to cash from that May through October period, and then buy back into stocks into the index from November through April, then you would have finished with more than $1.8 million. That's an annualized return of 9.3%, and while it's just above that annual average return for the buy and hold strategy, it obviously adds up. And even looking at the number of up and down years here, the number of years your portfolio was up or lost money would have been dramatically better with that sell in May strategy. Over the 62-year period here, you see stocks were up 45 years and down 18. That's in that buy and hold strategy. Just looking at each individual year on its own, stocks up 45 of those years, down 18 when considering the entire period. Now, just counting those months from May through October, those worst months of the market, really, you would have seen about a 50-50 shot, really. Of those 62, 63 years, stocks were only up 33 of those years, while stocks were down in 30 of those years. But again, looking at that November through April period, November through April, 6 months, stocks were up 53 of the 62 years, more than 85% of the time. Now, this isn't just all circumstance and magic, okay? There are some intuitive reasons why this phenomenon happens. And the summer period just sees lower trading activity as traders, institutional investors, or really a lot of investors just head out for vacation. That tends to depress the stock market, investor sentiment, and just amplify those swings. So if stocks do come down during the summer, it amplifies that and they fall harder. The summer period also just lacks a lot of the big blockbuster annual pumps of inflows that we see propel stocks higher. Things like end-of-year bonuses that always push stocks higher in January and December. Things like the beginning of the year where a lot of new investors come into the market on those financial resolutions to start investing more. That always propels stocks higher for January and February as people put more money into the market. Stock prices have held up extremely well, in fact, rising over the year-to-date period, as well as a very strong week last week on those earnings, despite heading into that historically weak period for stocks into several catalysts that could bring stocks down. So while I don't say you should go to completely in cash, I do say hold maybe 10 or 15% of your portfolio in cash, maybe a treasury ladder approach that we talked about a few weeks ago to earn some money, earn some return on that cash to give you the ability to take advantage of those lower stock prices when they come. Because I do believe there is going to be a sell-off. Might not be a big one, might be 10, 15% at the most, but it gives you the ability, the potential to jump back into the market with that 10 or 15% cash and take advantage of those lower prices. I've also covered a lot of my stock positions with covered calls at least through July, August of this year. So through that typically rough period, maybe even through October, sell some calls against some of your stock positions to take the risk off of that. Collect the premiums, collect the cash premiums on those, and hedge some of your downward risk. Want to highlight some of the stocks I'm watching this week, as well as a big week for economic news, the Fed meeting. We've got the monthly jobs report, going to talk about that. First up here, Generac Holdings, ticker GNRC, expected to report just 49 cents a share on earnings on Wednesday, as this leader in portable generators really struggles in its transition to solar panel power. Okay, so Generac controls about 90% plus of that generator market. It's trying to transition into solar panels, though. It's making acquisitions. It's doing more R&D spending. So a lot of investors are worried that it's eating up a lot of that cash flow, all that free cash flow that comes in from that portable generator market, pushing it into solar power, and whether that's ever going to be profitable. Okay, the stock was the worst performing in the S&P 500 last year, losing 65% of its value. Is expected to post a 26% drop in earnings this year on a revenue that's going to be 10% weaker. All that said, I do own shares of this company. I think this is a very strong stock. Again, they dominate the portable generator market, which isn't going away. Okay, we're seeing more hurricanes, more tornadoes, more natural disasters than ever before. Each year, we're going to see that. We're going to see generator demand climb there in the later part of the year. I think this company benefits from that. It's making advances in that solar power segment that is eventually going to give it more growth to this stock, and it's trading at just 1.4 times sales. That is less than half its normal valuation. Realty Income, ticker O, is also going to be reporting its earnings on Wednesday. This is investors' favorite monthly dividend REIT. It's expected to post flat profitability for just 34 cents a share against 13% revenue growth. So very much seeing here that revenue growth is increasing, but all those costs, all the inflation, the cost inflation is keeping earnings down. Shares have held up relatively well, though, here, only falling about 10% over the last year versus that entire REIT complex. The REIT index has fallen about 25% on higher interest rates. Obviously, real estate very much over leveraged. So as interest rates go up, it increases the cost of doing business for those real estate firms, for those REITs. It's hit the market this year. Investors are going to be watching for an update to the company's move into gambling properties for growth. Okay, Realty Income traditionally has only held those consumer staple like convenience stores, retail, pharmacy locations, things like that. Very little growth in that segment. So it is moving into gambling properties. Give it a little bit more growth, but it is also going to be a little bit more cyclically sensitive. Okay, so gambling properties obviously falling during a recession. That's going to hurt the stability of this stock, but it all is going to give it that growth and hopefully keep growing those cash flows. Paramount Global, ticker PARA, is going to be reporting its earnings on Thursday, with earnings expected to plunge 72% from the same quarter last year. That would be down to about 17 cents a share for Q1. That's on just 1.3% sales growth. So anemic sales growth for this streamer as well. Warren Buffett's Berkshire Hathaway, though, owns 15% of this company. That is one of the largest holdings of the Berkshire Hathaway portfolio. There is reason to be optimistic, I think. Earnings are expected to rebound quickly next year, about doubling really with higher ad spending. And Wall Street Journal reports recently that the company may be exploring a sale of for a majority stake in its online kids learning service called Noggin. Okay, a sale would support cash flow and really boost the company's efforts to boost its content in its streaming service. DraftKings, ticker DKNG, it's another stock I own, another stock I really like over the long term, but they are going to have to justify this year's 98% surge in the stock price when they report on Thursday. A gambling company is expected to report 66% growth in revenue and really a smaller loss of just 86 cents a share versus $1.14 per share in last year's quarter. I do own the shares. I own the shares at a cost basis about $12 a share from last year. I'm a long-term positive on this, but these big runs ahead of earnings always make me nervous. Okay, I think the downside risk of just disappointment and giving back some of those returns is larger than the upside potential here when it reports on Thursday. I've covered my shares at a $25 level with those call options, so I've sold call options against the stock at a $25 strike price. That means I still participate if the stock goes to $25 or beyond to $25 a share. I still have that participation in the upside, but it has lowered my risk a little bit by selling the call. AMC Entertainment, ticker AMC. A lot of investors are going to be watching this. It's expected to report very positive results on Friday. A loss of just 16 cents per share versus a loss of 65 cents a share last year, and on 20% sales growth for the quarter. So shares are already up 40% so far this year. Could have further upside as the theater operator moves into what could be a very strong summer blockbuster season. Okay, if we see movies like The Flash, Guardians of the Galaxy 3, Fast X, if we see them become blockbuster statuses very quickly, pulling people back into the theaters, AMC could have a very strong rebound effect. Now, I still do prefer the APE preferred shares here. I think conversion has now been postponed for at least a couple of months, so it's going to keep those shares, those APE shares under distress, but those preferred shares were created with the expressed intent of converting them into regular shares on a one-to-one basis. So I think it's only a matter of time here, and that provides the higher potential upside. Another big week for earnings. In fact, the biggest week for earnings so far. We've got a lot of companies reporting their earnings out. That has been pretty good so far. We've got an aggregate decline of about 3.7% in S&P 500 earnings. That is better than expected, although it is the second straight quarter of falling earnings, and we are expecting another 5% decline in the second quarter. So that's going to be 3 straight quarters of declining earnings. It's pretty much baked into stocks, though, so that's why stocks are rising as companies slightly beat those expectations. We do see the Fed meeting on Wednesday. It's expected to bring the last interest rate hike of the cycle. Okay. In fact, the CME FedWatch tool shows the market pricing in odds of 84% odds that the Fed is going to raise its rates 0.25%, with just about 16% that say that the central bank holds rates steady. So definitely going to be raising by about 0.25%. The market is now pricing in the possibility, though, that the Fed cuts rates by September or November this year. Inflation has still been too high to say that, but if we do start seeing inflation come down, Fed could be ready to cut rates by towards the end of the year and really support the case for stocks. As if all of that weren't enough, we also had the monthly jobs report here on Friday. Expectations for the labor market to cool further to just 180,000 jobs for the last month. That would be versus 236,000 jobs created in the month before. Now, hourly wages are expected to climb about 4.2% on an annualized growth basis. That'd be about the same as the report last month. Despite layoffs in tech, though, the jobs market has been extremely strong. That hourly wages has been extremely high lately. I think it probably does a little bit higher than that, maybe higher than 4.2% annualized growth on hourly wages, maybe a little bit stronger than that 180,000 jobs expected. I think that could bring the potential to spook the markets a little bit, show them that inflation is still there, that the economy is still growing too fast for the Fed to stop raising rates and cutting rates eventually. So I think Friday is probably the big chance for the market to weaken. One opportunity I think investors are overlooking is in the options market. We see here the CBOE volatility index, the VIX, that classic fear gauge. And what this actually measures is futures pricing to get a measure of expectations for volatility over the next 30 days. So despite some of the huge moves in individual stocks we've seen, the investors in the futures market are saying that they believe volatility over the next 30 days is going to be very subdued. Okay, we see here the VIX right now is 15.78. That is the lowest it's been in years. It's the lowest it's been this year, definitely lowest it's been since September, peaking out at 31.6. But going all the way back here to August of 2021, it hasn't been this low since then. So it is extremely low right now. And what you have to understand is the options market, those put options, those call options, the right to buy or sell a stock into the future is priced off of volatility. Okay, if stocks are jumping around right and left, jumping around by high amounts, and volatility is very high, then the premiums on those call and put options are going to be very high. Okay, because if you are selling another investor the right to buy your shares from you, or if you're selling another investor the right to sell you his shares, then you're going to demand a much higher premium if there is a greater likelihood that that option is in the money, right? If stocks are jumping around and fulfilling a lot of those premium or those strike prices on options. So as the VIX volatility index comes down, those premiums get smaller. Those option premiums come down. As the VIX jumps, those premiums for those options go higher. I know it's a little confusing, but what you have to understand here is this buying and selling call or put options is another alternative to just buying or selling the stocks outright. Okay, if the premium for buying a call option, the right to buy a stock into the future, if that has come down because the volatility index is down so low, multi-year lows, then it could make better sense to buy call options than buying the stocks outright. All right, because you are getting a better deal buying those call options, still taking advantage of that upside potential in those stocks by having to lay out a much smaller part of the money for that stock. Conversely, if you think the market is going to come down, but the volatility index is down so low, then those premiums for put options, you can buy a put option on the market, on the S&P 500 to cover the risk in your portfolio. You can buy a put option against some of your stocks to cover the downside risk in those stocks. And that put option right now is so cheap because volatility is so low. So it makes it very inexpensive, very effective to be able to buy these put and call options or to sell these put and call options in the market, much better than just going in and buying or selling the stocks themselves. Click on the video on the right for the 11 stocks too cheap to pass up right now. Stocks trading for a 68% discount to their fair value. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.